Let's get started here. Oh, they left them out. I say that's an invitation. Help yourself if you want a sucker. Okay. Kind of wake you up a little bit after lunch. You're welcome. I have to remember to start buying those for all my classes. Right on, we are going to continue on with chapter 5 today. Oh, and I forgot to shoot. I thought I updated this. I didn't save it. Oh, darn it. Okay, well, what we're going to do, we'll start out kind of with a review of those food tax rates. And I've got some practice problems that we can go through to kind of help solidify our understanding of how that FUTA works. And then we'll also start talking about SUTA tax. So let's get started, shall we? Okay, so as we started discussing, so we talked about what types of wages are subject to FUTA tax, the fact that it's only the employer that is paying that FUTA tax. We talked about how FUTA and SUTA work in conjunction with each other, and how FUTA tax, the taxes that are collected are used to administer the program. The actual benefits that are paid, unemployment benefits that are paid out of SUTA taxes that are collected. Talked about lots of other things as well, but just kind of a little recap. So that FUTA tax, remember, is a 6%. So as a reminder, whenever we're talking about how much tax liability there is for something, we're always going to take our base times our rate, and that's going to equal our tax liability. So as with Social Security, FUTA tax has a limit on its wage base. It's not unlimited. In fact, it only goes up to the first $7,000 of income. Now recall, that is $7,000 per employee per employer. So if an individual has several jobs, the employer for each of those jobs has to pay FUTA tax on the first $7,000 of that same employee, right? So that $7,000 doesn't carry over to a different employer. It stays with that one employer. But $7,000 is the maximum, and this again is just for FUTA. And then our rate is 6%, and that will get us to our tax liability, which, remember, we talked about, if it were the first full 6%, would be $420, per employee. So if we have 10 employees and they all meet that $7,000 threshold of income during the year, the employer is going to have to pay $4,200. I would multiply that by 10 for FUTA tax. But remember, we also have this FUTA tax credit of 5.4%, and that credit reduces the rate down to 0.6%, which means our base is still the same. The most that an employer would pay per employee would be $42 per year in FUTA tax. Now recall, there were two factors that have to be met in order for the employer to receive that full 5.4% credit. Those factors were, you got to pay all of your SUTA tax on time. And of course, this is the incentive for paying it on time. They want it paid, the federal government wants it paid on time, because otherwise, remember, the federal government, if the state doesn't have enough money in their trust fund for unemployment benefits, the federal government has to step in and make up the shortfall, which means the state's taken a loan from the federal government, and the federal government would rather not have to do that. So this is an incentive to employers to try and make those payments in full so that it keeps the trust fund solvent. The other way, remember, was if you have the bad luck of being in a state that is in arrears, has borrowed money from the federal government for FUTA taxes or to help with their SUTA funds, and they're late on their repayments. If that is the case, then every employer is going to be punished with effectively what is a higher tax rate. Remember, because if that maximum credit reduces our tax rate. If that credit is reduced, so let's just say it's a 4.4 credit because of maybe you're in a state where they haven't repaid it in time, now that makes your tax rate 1.6%. So any reduction in that credit is going to increase the tax. So there's an inverse relationship between those two items. Okay? Let's see. There was another thing. Oh, so I guess I kind of already went through this, but I already reviewed that. I'm not going to go through that again. So the credit itself, if there is a reduction of the credit, it is reduced 0.3% per year that the state is late in repayments. So this is only if the state is late in repayments. Like Iowa's not borrowed from the federal government for its unemployment benefits, so Iowa's cool. California seems to be perpetually behind and seems to always have to borrow in order to meet their obligations. But for every year, beginning in the second year after the advance, this credit is going to then be reduced. So if it was 1 year late, this credit, instead of being 5.4, would be 5.1, and our tax rate would now be up to 9%. So again, and then if you're 2 years late, that's going to go down then to 4.8. That's going to go up to a 1.2%. So the more that the state can be on time with their payments, with their repayments, the more that's going to benefit employers in that state. Okay, and as it says here, so additional credit reductions are possible beginning with the third or fourth consecutive year in which that federal loan is not repaid. So the first few years, it's 0.3% reduction, but that 0.3% will go up if you are more than 3 or 4 years in arrears with those payments. Okay. All right, so before we start talking about SUTA taxes, actually, I'm going to do a couple of examples up here on the board, and then I'm going to hand out this worksheet so that we can work through some examples on our own. And this is just concerning food attacks at this point. We will do some practice on food attacks as well, but we'll do that after we kind of get a full understanding of how food attacks works. Okay, so let's say that we're an employer and we have 4 employees. Okay, here's our employees. We have 1, 2, 3, 4. I won't give them names, we'll just give them numbers. And employee 1, let's look at on an annual basis. Employee 1 on an annual basis makes $10,000. Employee 2 makes $25,000. Employee 3 made $3,000. And employee 4 made $7,000. So this is their total salary. What we want to look at is what is their taxable, their FUTA taxable salary. So remember, we're limited to $7,000 of taxable salary per employee per year. So how much taxable salary does employee 1 have? Yeah, 7,000. It's going to be 7,000 without going over, kind of like the Price is Right, right? Up to $7,000 without going over. What about employee 2? Yeah, same, 7,000. What about employee 3? Only the 3,000, right? It's going to be limited to 7,000, but if it's less than 7,000, it's going to be limited to what the employee's salary is. So you can kind of think of it as it's the employee salary or 7,000, whichever is less. Okay? And what about employee 4? 7,000, right? Happens to be exactly equal. So if we add all of those up, what's that? 24,000. And let's say this employer gets the full credit. That means that the tax rate 6%, but they're getting that credit of 5.4. So 0.6%. We're going to take that 0.6, multiply it by 24,000. And this can get a little tricky, kind of like that additional Medicare tax, because it's a 0.%. You got to be really careful about your decimals and where you place them when you're doing the multiplication. So 24,000 times 0.006. When we're putting it into decimals, it'll be 0.006, so $144. Oops, not a comma. That's not too bad for 4 employees that they paid $144 in FUTA tax for the year. Now, one thing about the FUTA tax, and I think we get to this further down into our slides, but I do want to mention it. I want to mention it now because I want to do an example that explains it. So remember, we went through and talked about when payments are due for income taxes and Social Security and Medicare taxes. And it all depended upon how much the liability was, right? The higher the liability, the more frequent the employers, or the quicker the employers had to pay. Remember, we had that semi-weekly pay schedule, monthly pay schedule, next day pay schedule that may have to occur. Now, with FUTA taxes, it also has a pay schedule. It's not as complicated as the schedule for federal income taxes and state income taxes. How this schedule works is once the FUTA tax liability reaches $500 in a year, then the employer has to make those payments every quarter. If this was annual for the whole year, this is what the employees made, $144, they didn't meet that $500 threshold, they don't have to make the payment until the end of the year. actually when the form, that 940 is due, which is January 31st. So they could just make that payment once. They don't have to do it on a quarterly basis. But what I want to do is an example of what happens when an employer does reach that $500 threshold. So what you have to do is you have to look on a quarterly basis how much is owed every quarter. And you have to keep track of each employee, how much liability there is for each employee for each quarter. So let me put together a different kind of chart here. We're going to look on a quarterly basis for what employees make. So all right, so we've got quarter one, quarter two. We're going to have two columns for each quarter. Quarter three, quarter four. And I don't know if we need a total or not. All right, so in the first column here, we're going to say the quarterly salary, and the next column will be the FUTA liability. All right, so let's say that employee one in the first quarter made $6,000. Employee two, $3,000, three, $1,000, and employee four made $8,000. All right. Looking at this on a quarterly basis, in the first quarter, only one of these employees has reached the $7,000, right? So that means that these other employees are going to probably reach that threshold. Maybe they won't. Maybe this guy won't. In one of these subsequent quarters. But we have to figure out for the quarter how much is due, because we have to determine if we've met that $500 threshold. So how much of this $6,000 is subject to FUTA tax? All of it. All of it, yep. So 6,000. Yep. How much of the 3,000? Yep. 1,000. 7,000, exactly. All right, so we would have to do the calculation. So $6,000, this is, I guess I should have done three columns for each quarter. So this is our FUTA taxable wages here. And then this is our FUTA tax. And then we're going to do it again for the second quarter. All right, so we would take that 6,000 times, what's the tax rate? Yep, 0.6%. So $36. Let me guess, 18, because that's half. 1,000 times 0.06 is what, $6? Terrible. Yes, 6. And then this is going to be $42. So here's our total liability. We would add all of those up. We don't necessarily need to add all of those up. So in total, what we owe for the quarter is 18, 6 plus 42, $102. All right. So we've got that hanging out there. We don't have to pay it. We haven't reached $500 yet. We'll have to pay it at the end of the year if we don't ever reach that $500. But right now, we don't have to make payment. It's due, we owe it, but we don't have to pay it yet. So let's look at the second quarter. Sorry, and it didn't leave enough room here. Let's give this person a higher salary at this point. Although actually, I don't know that we're ever going to reach 500 on this with these scenarios. We need more employees. But anyway, we'll continue with this. So let's say they made another $6,000. This one made $5,000. This employee made $6,000, and this employee made $14,000. Oops, my handwriting. All right, so these are our wages here, or salary. Now, we're going to look at our FUTA taxable wages in the second quarter. All right. How much of that $6,000 is going to be taxable? 1, exactly. Why is that? Exactly. We've already applied $6,000 of their total wages. So only the first $1,000 is going to be taxable in this second quarter. What about employee 2 here? They've got $5,000 and they had $3,000 in the first quarter. How much more would they need to get up to 7,000? 4,000. Yeah, they made 5,000, but they were at 3,000. So they would need an additional 4,000 to get up there, right? So 4,000 is going to be taxable in that second quarter. How about this employee here? How much is taxable? 6, right? All 6 of it, because they had 1,000 before, so they need an additional 6 to get there. This employee, 0, right? We've already absorbed that whole $7,000 in that first quarter. So let's look at the FUTA tax that is due. 1,000 for our taxable wages. So we got to make sure that we make that distinction between our total wages and then our taxable wages. So $6 here of FUTA taxes. 4,000 times 0.006, $24. Should be able to do that in my head. Of taxes. Here, all 6,000 are going to be taxable, so $36. And our tax here is 0. So now we've got, I can do this in my head too, so $66 of FUTA tax. But so far this year, we owe 102 plus the 66. So our year-to-date liability is $168 in FUTA tax, right? We still don't have to make a payment at this point. Chances are, because we only have 4 employees, I should have chosen more employees than that, because we're always going to be limited to the $7,000. In order to get up to that $500 liability, you're going to have multiple employees. But you look at it on a quarterly basis. Okay, how much do we owe this quarter? Do we have to make that payment? If we got up to once we got up to $500, so let's just pretend for a second in the second quarter, it was enough that we hired some additional employees and we got up to $500 of liability. At that point, we have to deposit all $500, and then in the subsequent quarters, we have to deposit whatever we owe. So we have to continue depositing whatever we owe at that point. Okay? Does that make sense? Yeah. Okay. So just kind of wanted to do that, give you a preview. I think it's discussed later. Sure. All right. I'm going to give these out. So there's a front and a back here. This one is not done on a quarterly basis. This is just annual basis, how much did they make, and then calculating what that FUTA tax is. Yep. And I might give you guys a couple of minutes to work on that on your own to see what you can come up with. And then we'll look at it together.